fixed income, right? So as usual, I like to do like a kind of space where we're doing both the YouTube and the Twitter, just so that we can look at the slides together and then we can sort of follow. I think it makes it a better experience. So if you want to follow, of course, on the YouTube, I just shared the link. Also, if you want to follow on Twitter, I'm going to share the slide here on Twitter, so that way you get what's it called? You get both experiences, but YouTube is going to give you, should we say, the best visuals, as it were, right? Fantastic. So here we go. We're talking how to build wealth using fixed income. So real quick, what is fixed income? Everyone in Nigeria always starts off talking around, I want to buy shares. If you ask one, where are you investing? They said, I'm buying shares, or I'm doing crypto. That's another popular one. I'm doing crypto and all that. So really, folks want to do what makes them the most money, or they hear makes them the most money. What we want to do today is to talk around fixed income. That is an asset class that we all need, irrespective, right, of what our investment objective is. We need to have a bit of fixed income investment in our portfolio, right? In all our portfolios, right? So I'm just going to share a trend on Twitter. So if you're on Twitter, you're just going to follow that trend. And I'll just share the first one now. So let's start off real quick, right? What is fixed income? When we say fixed income, we're talking about income that you know the end number at the very beginning. So when you do a fixed deposit, which is one of the most common ways that we do fixed income in Nigeria, you know the end, you know what you're going to get at the end of the term or the duration when you do fixed income. That's really what fixed income is, as opposed to, say, variable income. Variable income is where you are buying, say, like a stock, in which case when you buy a stock of, say, Dangote cement, you don't know how much you're going to make at the very end. It's like profit and loss. If Dangote makes a lot of profit, you're going to make a lot of profit. If Dangote doesn't make a lot of profit, you also share in that loss. In that year, you might not get a dividend. And of course, in that year, the stock price might fall. But fixed income means when we buy that fixed income investment, we know exactly what we're going to get at the very end. So we have that certainty of a return, hence the term fixed income, right? So who is buying fixed income? Fixed income is really not, is like I say, it's for everyone. The difference is going to be what proportion of your investments do you want to put in fixed income, but the proportion is the difference. If you want to preserve your principal at all costs, really at all costs, right? Then of course you want to do fixed income. Let's say you have money to pay rent in 24 months. You can't lose that rent money, right? You want that money back in 24 months. So of course, fixed income is going to be where you want to go to. Very simple. What if you just want income? You are at an age where you don't want to grow your principal again, but you want to essentially grow, you want to just make income off your portfolio. Fixed income is going to be for you as well. What if you want insurance and balance? So you say, I have a portfolio, my portfolio is in stocks, it's in Bitcoin, it's in property, but I just want to buy insurance in case anything happens to that portfolio. Of course, fixed income is going to be your friend. And of course, if you have tax benefits, or if you want tax benefits, in Nigeria, if you buy long dated, which means you buy bonds that are longer than 2 years, those are tax exempt, especially when you buy federal government tax bonds. Those are tax exempt. So usually if you have a lot of funds and you want to make a lot of returns or income back to yourself, bonds are going to be the way for you, because you get that tax benefit. So that's going to be a key advantage for you when you do fixed income. Again, guys, the process is going to be this. I'm going to do this presentation real quick. Then if you want to speak or you have a question, just go ahead and request to speak. Once I get through these slides I'm going to do, they just go ahead and do your request to speak. And then, of course, we'll take your questions and then we can learn together, right? Okay, so my next slide, I'm sharing what are the pros and the cons of fixed income. Again, you can just follow the slides on Twitter, or you can go right to YouTube and just follow exactly what we're doing on YouTube. So what are the pros and cons of fixed income? The good, like I said, you want to preserve your principal, you want income, you want insurance, you want tax benefits. But what is the bad part about fixed income? Why do lots of people don't like fixed income, especially in a place like Nigeria? The key thing where I hear people say they don't like fixed income is because the yields are always lower, right? So if you look at, say, the yield on, say, a federal government bond, right, and you compare that with, say, maybe shares did 51%, bonds are doing about 15 to 20%. Folks will tell you that, listen, I make more money if I buy shares. Why should I go buy fixed income? The difference is this, right? Because you have a guaranteed return, then you are going to get a lower yield, essentially, right? So also that's a big minus for fixed income. Same with inflation. When there's higher inflation, the end value of what you're going to get is going to fall. So you don't make as much money in fixed income if inflation goes up, right? That's generally the situation. Same with interest rates, right? When interest rates go up, it also affects your fixed income investment in that the price would fall. Your yield will go up, but your price would fall. So inflation and interest rates also change the value and the return and the yield of your fixed income investment, right? So it's not all that fixed, but it's more, I would say it's more quote unquote fixed than equities. Then, of course, the issuer, you could buy a bond or a commercial paper from an entity, and that guy might fold up tomorrow, right? So you also have to worry about who you are buying from and all that, right? That's going to be a problem for you. That's why some folks don't like fixed income because of these issues of inflation and, of course, lower yield. But today we're just trying to show you that you have to have this in your portfolio, irrespective. Like I said, even if you're a young person, I always say young folks should do equities. But even though you're a young person, you have to have, even if it's 5% or even if it's 10% of your money invested in fixed income. It gives you that insurance, and it also protects your portfolio from the fall, especially what we're seeing now, right? Imagine if you are a young person, you are still correct to invest the bulk of your funds in equities, but look at what's happening in the world right now. So fixed income would have sort of guided you and given your portfolio a sort of, insurance on that, right? So let's continue to types of fixed income. We have many types of fixed income, right? They are defined by how do the duration or what they invest in, right? So if you look at my slide, money market is going to be the most popular fixed income investment in Nigeria is money market, most popular. Money market just means it's like a basket, and that company would then buy a lot of money market funds into that basket, and then you can then buy a share of that basket. So it's a good way for you to get the flexibility of deposits and withdrawals, but also get the exposure to a lot of fixed income funds in Nigeria. So that's one of the most popular funds in Nigeria. As a matter of fact, if you look at all the funds in Nigeria, and I have a slide for that, fixed income funds by far is the most popular investment in Nigeria in terms of funds, right? They are the most popular. They have the largest net asset values and the largest number of people that are actually investing in them. Then, of course, we have bonds. Bonds are just like money market, just that they are longer. So money market is basically 12 months and below, but bonds are going to be 12 months, I mean, and above. So just the term differentiates money market from bonds, right? Then, of course, you have dollar bonds, which is the same as a bond, but in this case, it's issued in dollars and it pays you a dividend in dollars. In Nigeria, you have the euro bonds, right? Euro bonds are very popular. You have euro bonds and you also have dollar funds. So euro bonds is you are buying the investment. Nigeria has borrowed money abroad, hence euro bonds. And you give Nigeria dollars, Nigeria pays you back dollars in interest. So we have dollar bonds, and we also have dollar funds, which are funds that are issued by investment houses that they take your money in dollars, invest, and also pay you back dollars. Fixed income is also real estate. But in this case, what we call our real estate investments for fixed income are REITs. The full name is going to be Real Estate Investment Trusts, right? REITs. So all a REIT is that instead of you buying the house, you are buying a paper that buys the house, which is very good because if you're a retiree and you buy a house, what if you need money tomorrow? Are you going to sell a room in that house? Not possible. But if you buy a REIT, you can sell just maybe 1 unit of the total yield portfolio that you have, and you're able to generate cash. So REITs also they invest in property. Property pays them the rent. They give you that rent as a coupon. So it's fixed income is a way for you to invest in property as fixed income. Then, of course, we have the specialized funds, the ETFs, the infrastructure funds, the Sharia funds, the ethical funds. All those are all specialized funds. Also very, very popular in Nigeria as well. ETFs don't do as well in terms of the asset value Nigerians are doing. Nigerians do more of mutual funds. But all this essentially give you your lay of the land for mutual funds and unit trust in Nigeria. So like I said, let's now go deeper, and let's talk about why you need fixed income in your portfolio. So I'm going to share this slide, very, very nice slide from Investopedia, right? And it's showing you the volatility in asset classes from 2006, in this case, till 2024, in this case. And you see the light green line is equities, right? So you see equities, the returns can go as high as 25%, as high as 30% in many of these years. But look at the fixed income line. The return, the highest return we have there is none has breached 10%. So no return has breached 10%. I think we went as high in 2008 when there was uncertainty. Also in 2018, it went as high as nearly 8%, but didn't breach 10%. But look at stocks, they are breaching 25%, 30%, almost at will, right? But again, look at the bottom part. You only find in two instances, I think it's in 2014 or so, when stocks, fixed income went below that zero line. And also in 2022, when we had the COVID, when everything crashed, that was COVID. So when I take that out of the picture, because it's an unusual black swan event. So what fixed income does for you is gives you that insurance. You're not going to make 30%, but you don't lose your principal. And that's what that slide is showing to us. So what does that mean for you as an investor? Whatever you're doing, you want to have a bit of fixed income in your portfolio because it gives you, it averages out your return. So when you are losing money in equities, you are making money in fixed income. So it's like a seesaw, right? So if you're doing 80% and you do 20% in fixed income, fantastic. The 20% might drag your portfolio in the good years. But when the market turns south, that 20% becomes your stopgap. It gives your portfolio income. It gives your portfolio a positive return. So again, it's got to be a portfolio, not an individual share, not an individual whatever. You've got to try to look at it in terms of a portfolio, right? And that's what that slide I'm sharing is. So I hope you guys are seeing the slides and are following, because I think that is fantastic for you guys to see the visuals. The visuals allow you to understand exactly what I'm saying, yeah? Okay, let's go to this slide about tips. I talked about that most folks do not buy bonds because they say bonds do not protect against inflation. That's actually not 100% correct, because in the US do have bonds that protect against inflation, right? They're called TIPS, Treasury Inflation Protected Securities. So essentially, when you buy that bond and there's inflation, then your principal increases, which allows you to then earn more dividends. So let's say you buy a bond for 1,000 and inflation goes up by 20%, the bond will now be worth 1,020, which then means that if you then get returns, you're getting returns on 1,020, and that allows you to then make, should we say, more money. So it's a very, very good way. Americans have done it. You would think a country like Nigeria that has high inflation, if they had a sort of bond that was pegged, even if it's a floating peg on, say, MPR or even inflation, it would be a very, very good sell, because lots of folks would then invest knowing that they're not going to get, their returns will be, at least will keep pace somewhat with inflation. So you can structure investments that keep pace with inflation. All that matters is that the country that is issuing has got to want to do it, right? It does incur a cost, because you have to, the government, of course, has to pay the difference between that inflation and the bond yield. But the return is that more folks will invest, knowing that when they invest in this, their funds are going to be protected from inflation. So very, very good one there from the US. Okay, let's look at this flow chart. What I tried to do again was to just give you guys a flow chart that is easy for you to follow, and to ask yourself, should I be investing in bonds or should I be investing in stocks? Because most folks are going to say, okay, how much should I invest in bonds, or should I even do bonds and all that? So what I did here is I went to my book. I have my book, Let's Talk About Your Money. You guys should get that book. If you haven't got it, go get it. It's on Amazon. It's 227 pages of investing not theory, real life. I give you the funds, I give you how to do it, i.e., step by step, like this flow chart I'm giving to you. So you start off basically by asking yourself one question: do you want to risk your principal? So if you're looking at the figures, it basically makes sense for you. Do you want to risk your principal? If you don't want to risk your principal at all, then of course you want to go on the right hand side, which is no, and that takes you to the fixed income side. If you say you want to risk your principal, you're going to go on the left, right? But how aggressive do you want to risk your principal? If you are for high volatility, you're saying like, hey man, I want to run this thing, I want to go on this thing, I want to make as much money as I can. That's high volatility, right? You're talking crypto, you're talking small caps, you're talking shares, you're talking private equity. You go high, you lose high, and you also gain high. If you buy crypto, you can go to zero, you can go to 100. That's basically high return, high risk, and all that. Then you've got about the moderate volatility. That is your blue chip stocks, your emerging market stocks like your Nigeria and all that, Korea. Those are emerging markets, and you're buying blue chip. So there's volatility when compared to bonds, but it's just moderate because of blue chip stocks. Then if you do basically want, yes, you want to risk that principal, but you also want low volatility, you can go to the REIT, which is the property, right? So, but on the right hand side, you're saying, I don't want to risk my principal at all. I want what I give you, what I get back. So we now have to look at the investment horizon, because we're not risking your principal. You're going to get your principal back, but when do you want it? If you want that principal back in less than 90 days, you should just be doing money market, commercial papers, that sort of stuff, treasury bills, that sort of stuff. You're not doing bonds per se, yeah, because you want the money back in less than 90 days, right? If you want it more than 90 days, right, we're going to ask you, do you want to withdraw your principal, or you want to withdraw your interest you're going to earn? Do you want interest you're going to earn? If you say yes, we're giving you commercial papers, right? Or we're even giving you savings bonds where they pay you that interest quarterly. If you say no, then it's going to be bonds, right? You want to just let that bond roll over. But the main point is this, right? If you want to, you look at the duration if you don't want to risk your principal. But if you want to risk your principal, you're looking at the type, the volatility. And that sort of gives you a good way to know, should I do bonds? Should I not do bonds? But the point I'm making, guys, whatever you're doing, you have to have an exposure to fixed income. That's why I'm doing this, right? Because you cannot just say, hey, I'm just going to do all equities, I'm going to do all crypto, and I'm going to make money. You want to have an exposure to bonds as well. Now let's look at this chart I just shared, right? I did a lot of research to get this chart out, a lot of research. I tried to look at all the collective investment schemes in Nigeria. So collective investment schemes are going to be your mutual funds, your REITs, your real estate funds, all those kind of things, the collective schemes. January 16th is the latest date that they have on the SEC website. So then, and I did this as of yesterday, right? So as of yesterday, the latest date was January the 16th, 2026. So I'm looking at the funds Nigerians, where Nigerians are investing in, not even the return, just to give you an idea of where the money is going to. The number one investment the Nigerians are doing in terms of funds are your money market funds. If you look at your money market funds, you've got about nearly 626,000 Nigerians doing that. About 63% of the total funds in collective schemes and money market funds, about 5 trillion. 5 trillion. I think the total collective investment funds should be about 8 trillion, nearly 9 trillion. About 5 of that is in money market funds. That's where Nigerians put the bulk of their money in money market funds. The largest player there's going to be Stanbic IBTC. So what's the next market where Nigerians are investing the bulk of their funds? Surprisingly, is dollar funds, right? So dollar funds, you have very, very little Nigerians. In terms of number, about 29,000 Nigerians are investing about 1.9 trillion in buying dollar bonds, euro bonds across the collective investment scheme framework, right? So that's about 24% of the total assets in collective investment schemes in Nigeria are invested in dollar funds. So we have money market, number one, then we have dollar bonds, number two. So lots of Nigerians are holding dollars, right? You know when we say hold your dollars, this is the data to back it up. Nigerians are holding a lot of dollars. And this is not even dorm accounts. This is just funds, i.e., mutual funds, and of course, dollar euro bonds, not euro dollar account, just those two. So Nigerians are doing a lot of that. What's number three? It's real estate funds, right? So Nigerians are doing a lot of real estate funds. About 233,000 Nigerians own about 6% of the total collective investment schemes that is invested in that real estate fund, about 504 billion. Then we have the bond funds, about 3% of that, about 242 billion. Then we have equities. Equities that makes a lot of noise, right? It's down the pecking order. About 70,000 Nigerians. This is a troubling number. Only about 70,000 Nigerians, about 70,500 Nigerians do equity funds. They could be more buying equities, right? But this is just the funds. Just about 70,000 of them buy funds through equities, through equity funds. About 1.7% of total AUM, about 93 billion. That's not a lot, 93 billion in total assets under management Nigerians are doing. And of course, you have your ETFs. Again, that's so small. Infrastructure funds, only 26 Nigerians or Nigerian firms are doing infrastructure funds. That's why I don't see a lot of money going into roads, toll gates, railways. Not a lot is happening there. Total asset size about 146 billion. So this tells you that there's a lot of opportunity. Just think about it. And the guys you see in money markets are the same guys you see in equities, are the same guys you see in infrastructure funds. It's the same people. So it's not as if we can add up the investors and say total of 1.2. No, the total investor I think I saw in that report was 1.1 million. So about 1.1 million Nigerians have about 9 trillion invested in collective investment schemes. That's not a lot. That's not a lot at all. It just shows the huge gap Nigerians have with investing and where they should be investing. So big fund there. One thing I did notice that what I found interesting was that if you look at the number of Nigerians that do the ethical funds and the Sharia compliant funds, it's a lot. It's a lot. Nigerians are doing the Sharia funds, i.e., equities, bonds, fixed income for Sharia and ethical funds, a lot. So if you are thinking of bringing out a fund for Nigerians to invest, you might want to think that strategy and say this is where I think the market is, because lots of Nigerians are interested to invest, but invest according to their ethics. It doesn't have to be. It's not all quote unquote one religion. It's ethical investing, and I think that even in the US they have investment that invest according to Sharia, according to the Christian beliefs. You can actually buy a bond or equity that invest according to Christian beliefs and according to Islamic beliefs in the US, in London. So Nigeria is just basically catching up, but that's going to be a big way to get a lot of investors to come to the market. So if you guys are following, we're almost done. Now we're at the core part of our presentation, which is the fixed income strategies, right? So like I said, most of you guys do fixed income investing. I see most of you guys do those apps on your phones where you are putting money and you're getting return. Are you doing it the right way? Okay, maybe you are, but I want to show you a way that you can invest, right, in that fixed income strategy so you can do it the better way, right? Because this is how the professionals do it. So you want to copy the professionals and then see if it does well for you. So there are three strategies here I want to share with you. One is called laddering. And we're going to talk about what laddering means. Laddering. The second one is called barbell, like your barbell in the gym. And the third one is called discount and premium bond investing. So again, like this is what the professionals do. So you're not going to be a professional tomorrow, but understand it and see if you can incorporate it in how you invest. It's not that hard. There are many strategies. These ones I think are the easiest to explain and for you to adopt and implement even from tomorrow. So let's start from the first one, which is going to be the laddering, right? Laddering just means, just think of a ladder, right? And you see all those rungs in ladder where you go from one rung to the next rung and all. When you are laddering, you are splitting your share, your bond portfolio into different portions. So let's say you want to invest 10 million naira and you want to invest that 10 million naira for 1 year and you want to do money market. Instead of doing like I see most of you guys do, you take your money to the app and you put money in the app and you lock it up for 1 year. Instead of doing 10 million for 12 months in one app, you should do 2 million for 3 months, 2 million for 4 months, 2 million for 5 months, 2 million for 8 months, 2, 4, 6, 8, something like that. So what you're doing is that you are saying, because in Nigeria, again, you don't know where interest rates are going to go to. They could be up, they could be down. So what laddering does is you take that 10 million, you say, I'm going to do every 2 months, I'll do 2 million. So I'm going to lock it up for 2 months. I'm going to lock it up for 4 months. I'm going to lock it up for 8 months, for 6 months. We're locked up for 8 months. So you take that 2 million for 2 months, 2 million for 4 months, 2 million for 6 months, 2 million for 8 months. You've laddered that portfolio. And what you've done is that you said, if rates go up, fantastic. You already have money invested. So if rates go up, that's bad for you. Because if you had locked up your money and rates go up, you're going to lose money because you've said, I want to get money for 12 months and you've locked it up, but rates have gone up. So that's bad for you. So if rates go up when you have laddered, when your CD in matures in 2 months, you pull it out, you invest again at a higher rate. What if rates go down? You are also fine because you've also locked your rates up for 8 months and for 6 months. You're only going to get a loss on your earlier 2 months and maybe your 4 months CDs. Sorry, placement. You see what I mean? So when you are laddering, you are spreading your portfolio according to a timeline to take advantage of both the high and the low interest rates to give yourself flexibility. It's the same 10 million you're investing in the same app, but because you spread it out, you ladder it and you're able to take advantage. You don't have to worry too much if rates go up and rates come down. So this is a simple one to do, right? This first one I'm sharing the slides with you here, the simple one. If you want to invest money for just less than 6 months, you're doing your savings account, you're doing your call deposit. Simple. You don't have to look at a fixed deposit. You just you have the money. You don't know when you want it, but you know you don't need it. You just do a call. You put the money on call. You go to your bank and say, "What's your call rate?" They give you a call rate. You put it there. End of story. Because you don't know when you need it. You don't fix money you need. Because if you try to break the fix, they will charge you. So you don't know when you need it. You put in a savings account or you put in a call deposit, right? End of story. What if you then want that money for a longer period? Say you want it for 12 months. Yes, you didn't do a fixed deposit or certificate of deposit, or you do a commercial paper. Commercial paper means that you are not lending money to the bank, you're lending money to the customer of the bank, right? So if you go to the bank will tell you we have Dangote commercial paper. That means that Dangote is giving you, it wants to borrow money from you. You give money to Dangote. So that's your Dangote commercial paper, right? If you want to invest for more than 12 months, maybe you want to invest for 3 years, you're talking about a certificate of deposit, also federal government savings bonds, because those ones allow you to invest for 12 months, for 36 months, and you get your dividends every quarter. If you're doing more than 24 months, longer, 5 years, 6 years, 7 years, you want to do a corporate bond. So this is an easy one to understand because it's just the duration, right? So we just do, if it's 6 months, we're doing fixed deposit. If it's 24 months, we're doing bonds. This is an easy one. Let me show you a bit more, not harder, but a bit more structured one that you want to do. So let's say you want, like this guy now, this one I'm just picture I'm sharing. This guy wants to invest in CDs for 5 years. And like I said, instead of you taking the money, right, and investing 10 million for 5 years, you break that CD down. You break it down, say, to two. So 2, 4, 6, 8, 10, right? And then you invest the first year, you do 2 years. Second year, you do 2 years. Third year, you do 2 years. Fourth year, you do 2 years. The fifth year, you do 2 years. So what this guy is doing is very simple. Essentially saying that if interest rates go up, he's fine. Because if interest rates go up, his CD is going to mature in 2 years. He'll take that CD that's matured and buy a higher interest rate CD. He's not locked in. CD just means fixed deposit. It can be fixed deposit, CD, whatever you want to call it. But when he invests, if rates go up, his investments mature in 2 years, not 10 years. So that 2 million matures in 2 years. He gets his money, he can invest, right? It's like, let me make it easier for you. If you own a property and you want to collect rent, you can collect 10 years rent immediately today. You get 10 years rent and you say, oh, I have bulk money, I have 10 years rent, I'm going to go buy something. Or you can tell the tenant, we're going to give you a 10-year rent, but you're going to pay us every 2 years. And if interest rates go up or whatever goes up, the landlord, reserves the right to increase your rent. So what you've done is that you are saying if inflation goes up, you go back to your tenant and you say, tenant, rates have gone up, I'm going to increase your rent. So every 2 years, you have an opportunity to go back and increase the rent on the property, because for 10 years, yes, you get your rent for 10 years. But what if next year the naira devalues and rents go up 100%? You might say, okay, I got money ahead of time, but that's also a risk. There's a risk that you sold that in or property too cheap. So it's like a reverse. In this case, you are the reverse. You are the investor. When you go to your bank, you break the money down. So that way you can keep on reinvesting if rates go up. What if rates go down? If rates go down, that's fine. The one you have for 8 years, for 6 years, for 4 years, those ones are good because you've locked it in for long term. The short-term ones are going to give you back the money. That's where you might lose some money, right? So you are gaining and losing at the same time, but you're also losing and gaining at the same time. So it's like a negative, it's like a balanced way to invest when you ladder. And I can show you the ladder again for money market, because this is for 10 years, right? For 5 years, I mean. Let me show you the one if you are doing a ladder for, say, 30 months. You want to invest for 3 years. Same thing. You do your 6 months, you do your 12 months, you do your 18 months, you do your 24 months, you do your 30 months. You take the same principle, and instead of investing that principle for the full period immediately, you break it into same amounts but divided over the life of that investment. So that way you are getting the rate. Your maturity is coming due every period. When you get your maturity, you can invest or you can take the money and go somewhere else. So you're not locked into a falling or rising interest rate, because you don't know where rates are going to go to, right? Rates go up and down. So this is the way you want to, especially in a country like Nigeria where rates fluctuate. Bond laddering, money market laddering is a very, very good way for you to invest. So this is one thing I want you guys to learn today, how to do laddering. You can do laddering with any investment. It's just break it down. If you're doing those apps, instead of doing one app, one lock, one period, you take that same money, divide it into three, and you spread it into the future. So it's always maturing, and then you can take a decision to roll over or to take your money and go somewhere else. So this is what the experts do, right? So like I said, copy the experts. They know why they're doing it, right? So you want to copy them. The second strategy we're going to talk about, guys, is what we call barbell. The barbell, right? So that when you go to your gym, you see that barbell you have in your gym. You have weights on one side. You also have weights on the other side. So how do you do the barbell for bond investing? It's almost the same thing, right? So what we want to do is I want to take the two extremes we can have in investing in fixed income. The two extremes. What are the two extremes? We want to take very, very safe investments on one side and very, very volatile fixed income investments on the other side, right? So look at what we're saying here. If you were doing the barbell in Nigeria, how would the barbell look? You would have your federal government savings, federal government bonds on one side. Those are the safest investments in Nigeria. Your federal government savings bonds, your federal government issued bonds on one side. Very, very safe. You don't buy anything else. You go to the very, very extreme, and then you buy the very, very high paying, very, very high volatile fixed income, which are the commercial papers issued by companies and maybe are not even on that the banks won't even touch. Maybe you go to the off the balance sheet or off the normal trading pattern where banks go to, and you buy those very, very aggressive derivatives investment products. So what are you doing? You are saying these conservative securities on this side are giving me income. That's fine, but they're not growing. They are conservative. I get my income. They are very, very boring. I won't lose money, but I get income. But that aggressive portfolio, if I invest a 1 million naira in, they are paying me 30%. So I can make 1.3 million with that very, very aggressive bond that I've invested in. But I can lose my investment because the issuer is very risky. So I'm doing 30% on one side, but on federal government side, I'm doing like maybe 10%. That's my barbell. Low risk, high risk, nothing in the middle. I'm not trying to do, oh, let me do a bank that is paying me 15%. No, I'm doing federal government, and I'm doing very, very aggressive, very, very volatile fixed income on the other end. So if rates go up, right, I get my money back from the hyper aggressive borrower. If rates go down, I get my money from the federal government bonds. So that's again under strategy that folks do to say, either way in the market, I am covered. The aggressive guy, I can lose my money there, but I'm getting the capital appreciation. It's not capital appreciation per se, but you're getting the high returns on your fixed income with that aggressive guy. But on the conservative guy, you're just getting your income back, your principal is protected. So if rates go down, your conservative portfolio does very, very well. If rates go up, your aggressive portfolio does very, very well. So again, it's very easy to understand if you look at it that way. You are not saying, oh, I lost money here. There's no FOMO. Whatever happens, you're sort of covered when you do a barbell strategy. Again, Google this stuff. Try to read it offline when you're done. It's just introduction to you, right? Try to read it more when we leave. So that way you can understand more about what I am talking about. Yeah. Yeah. So I see YouTube guys are funny. Okay. Yeah. Okay. Fantastic. So I'll get to the almost done, guys. So if you want to speak, just request to speak. So once I'm done, I'll just add you and I'll take your questions. So this is before I talk about the last strategy, which is going to be our buying premium bonds or buying discount bonds. It's important for you to understand this relationship between bond price and the interest rate. And you don't have to cram this. It's very, very simple. If the interest rate, when you hear interest rates in Nigeria have gone up, what's interest rate? That's MPR, that's monetary policy rate, or if you're in America, the Fed rate. If you hear those Fed rates have gone up, automatically just know that the price of bonds has come down. So it's an automatic relationship. Don't ask yourself why. Just know that's what's going to happen. So if today you hear that the MPR in Nigeria went from 29 to 26, what do you think happens to the price of bonds? If interest rates go down, the price of bonds go up. It's inverse relationship. If interest rates go up, price of bonds go down. Just remember that one is simple. Don't worry about why. That's just what happens, right? So how do you trade with this? This is now for the traders. This is now getting a bit more trady because someone's going to say, well, fixed income is very, very boring. I just put my money down and I just invest. If you want to trade, this is now where you now want to make some money on your fixed income investments, right? Now, if you then know, what if you know that bonds are going to go down? If you think that the Central Bank of Nigeria is going to reduce interest rates in their next meeting, what do you think will happen to the price of bonds? Remember, if interest rates for Central Bank of Nigeria go down, the price of bonds will go what? It will go up. So let me ask you a question. If you find out that the price of rice is going to go up, will you buy rice today or will you buy rice when it goes up? Of course, you buy today. Why are you buying today? Because it's cheaper to buy today. So if you know that investors are going to buy bonds today, what do? You're a seller or you're an early buyer. You see the point I'm making? This is where you see them when you hear them doing trading in the market. This is what they are doing. They are anticipating the rise of interest rates. But it's easy to anticipate rise of interest rates. The real traders will actually go and find out what makes interest rates go up and down. And if we can find out what makes interest rates go up and down, we can know if interest rates are going to go up and down, then we can take a position well ahead of the market. Here's the point. Look at what's happening today in the whole world. Iran and the US are fighting. So has interest rates gone up or have interest rates gone down? What do you guys think? There's a lot of risk. What do you think has happened? Everybody has run to the dollar. Because everybody has run to the dollar, the price of dollar has done what? It's gone up, right? Because everybody's going there. What happens to the interest rate for a dollar? It has gone down, right? Because people are running for safety. So once you understand this back and forth, as this one goes up, this one's come down, then you know how to make money. So if you then come to the bonds, right? If you come to our next slide here, which is look at this is the Nigerian Euro bonds, Nigerian treasury bills that Nigeria is borrowing money from, right? This is like our Euro bonds. If I wanted to invest in this market, if you look at, I hope this is not too complicated, guys. But if you look at this chart, the coupon, there's interest rate and coupon. The interest rate on the bond will never change. The interest rate will never change. So when you see this bond name, look at this. Just look at the first line. You see that 6.50. It will never change. This bond that is going to mature in 2027 will always pay 6.5. So if it's going to always pay 6.5, what are we trading? We're trading off the yield, Because remember what I said, if interest rates go up, the price goes down. So when you see this price of 101, it's always quoted at 100. So when you see 101, this means the price has gone up, meaning that interest rates went down. So you are buying this bond at a premium. So the folks that made money are the ones that bought this bond at 100. Now they're making $1 on this bond. This is in dollars, right? If you look all the way down, so this bond is going to mature in 2027. It's quoted at 93, which means they bought it at 100. Now it's gone down to 93. What is saying? It's saying that interest rates went up, so the price went down. So you are trying to anticipate if rates will go up or down. Then you want to take a position before rates go up and down. This is how you trade. This is how you make money in fixed income, right? This is if you want to trade. If you're not a trader, just focus on the two I already showed you, which is your bond laddering and of course your barbell. And of course, that way you're going to do well. All right, folks, I'm done. I'm done with my talk. So now we're going to take questions. I've got Jimmy on the line. I've got the YouTube folks with their questions. Let me start with Jimmy on audio. Then I can take questions, guys. And I just want to thank you guys for listening. I know it's like a seminar on a space. Space supposed to be talky, but this is good as well. You guys have a way to now. You'll now see a lot of stuff, and you can come back to me. Jimmy, go ahead. What's your mind?
Okay. Thank you very much can you hear me?
I can hear you, sir. Go ahead.
Okay. Thank you very, very much for this lecture. I really, really enjoy it. I'm looking forward for this lecture for some time now. Thank you very much. Although because of network, I can't actually see you were clear on the speaker room, but you can hear me well. I just want to ask you a question. Is on inflation and especially the purchasing power.
Yeah.
Yeah, purchasing power is very, very important because I know in 2023, I think I made an investment, although the fixed deposit I did in the bank.
Yeah.
And I discovered that at the end of the day, although the money increased anyway, but the purchasing power was very, very, it's something else in Nigeria.
That's
something
true.
else. I think with all these beautiful solutions, I think also some.
Jimmy, you want to go real quick and ask the question, so because I don't lose you, right? Okay, I think I lost Jimmy, but if I understand what I could get from Jimmy, I don't know if you're still speaking, but I can't hear you.
Yes, can you hear me now?
Yeah, just go to the questions. That way I can really answer you, right?
Okay. My question is, what can you say about this purchasing power? That is the key. What can you say about what is the best way to invest? Because personally, I believe in the context now that this is best to be done in the short term.
Yeah.
Not in a long run. But if you do it in a long run, the purchasing power is always dropping. So what can you say about the purchasing power? That's just what I want to say. I want to know. It's very, very important.
Yeah. The purchasing power means that what can your Naira buy for you? It has gone down in Nigeria because, of course, as you know, our inflation rate has gone up. So what inflation does is inflation reduces the purchasing power of the currency. So if you had a Naira last year, that same Naira today is worth 15% or so less. This is just for this 1 year. It's not the cumulative. So every year your purchasing power falls. That's why we invest. The whole idea for you to invest is that you want to try to at least catch or to bring back some loss of that purchasing power. So if you took a Naira and you bought a federal government bond, inflation for the year is about 15%. The federal government bond will pay you also 15%, risk-free, from about 15 to about 20%. So you can argue that you've not made a loss because you invested. But if you simply hold that Naira in your pocket, at home, in Naira, of course, you're going to lose value. Same way with the dollar. Dollar also has an inflation of about 2%. So if you hold the dollar in your hand, it's lost 2%. But if you buy a CD or you put in the bank, at least you gain something back. It's because of inflation, really, that people invest. Because if there was no inflation, you could just put the money in the hole in the ground wait for 25 years, bring it out, and also spend it. So I don't know if I answered the question, but actually, inflation is the key thing when we invest. So making a real return is actually very, very important than just making a return. Making a real return is very, very important. Yeah. Does that answer your question, Jimmy?
Yes, yes. But what I'm asking is, what do you see about, for instance, you also get investments, you get some returns.
Yeah.
But in the long run, that's what the question is. You talk about invest like say 10 years, 5 years downward like that. So in the long run, no matter how I just want to know if you invest in the long run, looking at the power and looking for the power in Nigeria, I think the dollar is going up, but the naira is really something else. So if you make an investment for a very long time, maybe 10 years, maybe 7 years or 4 years, your purchasing power is really going down. So no matter how much you make, you will still lose. I don't know whether I understand what I'm saying. Definitely, I believe short-term investment, because we don't know the direction, and from history we come to understand that our purchasing power, because of what we are doing in Nigeria, especially going down everything. I don't know whether you understand that.
Yeah, I hear you, but I don't think the numbers back you up. If you want to invest in equities, you have to have a long-term view. How much was Dangote cement 5 years ago? How much is it today? The market last year did 50%. That's the Nigerian all share index is 50%. What was inflation in Nigeria last year? Maybe 30%. So whether it's short-term, whether it's long-term, it depends on your objective and what you want to achieve. If you want to beat inflation in Nigeria, you have to be exposed to equities. But that equities exposure gives you more volatility and more risk. But you cannot beat inflation in Nigeria with just fixed income, unless it is dollar fixed income, which is why you see so many Nigerians are doing dollar returns in Nigeria. So the numbers don't back you up. If you invest, you make a return that beats inflation. What you might argue is that if you invest in fixed income in Naira, the returns will not beat inflation. You can make that argument, yes. But when you invest in, say, dollar funds, in, say, REITs, in, say, equities, the returns have beaten inflation over the short and even the long. What I mean short, medium to long term, yes, they're beating inflation. Yeah.
Thank you very much.
All right, Jimmy, thanks. So let me just go to YouTube. Police officer trying to create another source of income. I have saved and put all my money in a fixed deposit and use the ROI to buy stocks. So you want to take your money, you want to put money in fixed income and take the dividends and buy stocks. Interesting. It depends on how, I would say this, what's your objective? Because when you take that money, right, and you put it in fixed income, right, it's already, it might have already lost value because of inflation, right? Then you then take that return that has lost value to then buy a risky asset, which is equity. And then you want to hold that risky asset for a longer term. All things being equal, I think it's Emmanuel, all things being equal, right? I would do it the other way around. If I was a younger person, I would rather take my money and buy the equities direct, then take the dividends and then buy fixed income the dividends. So at least the dividends are the return from my holding a risky asset, and I take the dividends and I then buy a fixed income asset because I want to use the stocks to beat inflation in terms of the principal. Then the returns that are coming to me, I can use that principal either to consume or to invest to then create another stream of income. So maybe I might flip it around, unless your objective is just to make income. But if your objective is to make income, you shouldn't be investing in the stock market. Stock market is really for growing your principal, right? That's the first thing. Growing your principal is more stock market. If you want to make income, just stick with the fixed income. So instead of doing fixed income and shares, I would do it the other way around because I want to grow my principal, generate dividends, and I can use that dividends to consume or to buy other securities. That's the only thing I might say. But I don't know how old you are. I don't know your objective, but just reading what you just wrote there. Ashmel, how you doing? Ashime, did I get it right? Ashimi, yeah. Ashimi, you've got the floor. Please go ahead. Before you do, what's this guy saying? The first time I take dividends, I don't know what you're saying. Yeah, let me know. Stephen, I'm not sure what you're saying. Let me go to my messages. Can you talk, just want to clarify on the dollar fund. Yeah, the dollars you see here, this is all Naira. So this is not dollars, this is Naira. So according to Naira, the total Naira is 1.94 trillion. 1.94 trillion Naira, not dollars, 1.94 trillion Naira is invested in collective schemes for dollars. Ashime, how you doing? You have a question? Yes, so that's a Naira figure, not a dollar figure. Yes, and that means that people, when you buy dollar funds, you are investing with dollar, and you are getting a dollar dividend in Nigeria. It's not Naira. You can't. They don't take Naira investments for this scheme. They take dollar investments. And Nigeria, I think this investment is doing well because of the gyration of the Naira. So lots of Nigerians are buying this not to make a return per se, even though they pay a return, but because they want to protect the value of their Naira portfolio. So they have a portfolio also in dollars, and that sort of helps them to also protect the value. And like you have said, it's the largest, or you say second largest concentration of funds in Nigeria in the collective investment scheme space. So dollar funds, 24%, about 20, smallest percent of Nigerians do that, but you can see the impact. Yes, the largest player is the largest institution that is offering a fund that is offering that investment. So for instance, the largest money market fund is run by a company called Stanbic IBTC. The largest dollar fund is also run by a company called Stanbic IBTC. The largest real estate fund is run by a company called ARM. For the bond, that's United Capital. Equity is Stanbic. ETFs is Vertiva. And the infrastructure funds is going to be Chapel Hill. So those players are the companies. Then they then have vehicles or funds that allow you to then invest in money market or dollars. Hope that makes sense. Okaifo. It's Okaifo. Did I say that right? Okaifo.
Yeah, thank you very much.
How you doing?
I'm absolutely fine. Thank you very much. My question is actually very...
I think I lost you. Okay, if I lost you, if you're speaking, I can't hear you. If you're speaking, just I can't hear you. Real quick to the message. If you're speaking, I'm just going to read the message real quick while you're speaking. So I'm 35 years old. I do piggy vest. I do shares. I might do the right thing. Well, what do you mean by the right thing? What do you mean by the right thing? Give me why you invested in yeah. So yes. So let me just make this point again. Before you invest, like I always tell people, right? Before you invest, you want to do certain things. Like I've said it when you guys have been on my space. There are certain things I would like you to do first before you invest in Kobo, right? Number one thing is you like to basically get your objectives. Why are you investing? Very, very important. Are you investing for long term, for short term, for retirement? Get that, write it down, be clear on why you're investing. Number two, insurance is most second thing you want to do, not car insurance, but your life insurance. Before you invest, you want to ask yourself, do I have dependents? If you have dependents, buy life insurance first before you invest. Life insurance does not insure your life. It ensures the loss of income that your life is going to bring. So buy life insurance. Life insurance is the only investment you can put 1 naira down today and be worth 1 million tomorrow should anything happen to you. So you want to protect your dependents from you not being there. After life insurance, you do an emergency fund. An emergency fund is 3 to 6 months of your necessary expenses. 3 to 6 months. You have to do this 1, 2, 3 first. The last one you want to do is you want to take advantage of your company's retirement plan. So if a company has an RSA, or if you're in America, your company has a 401k, do that first before you start investing. So do your objectives, do your life insurance, do your emergency fund, take advantage of the retirement scheme your company has before you start to invest. Do all four before you invest. Oh, hi, how you doing? Go ahead.
Yeah, thank you. I apologize for my network.
No worries.
I have two questions.
Yeah.
And the first one, is it advisable to use money market or fixed income instruments to build an emergency fund?
Yes. Yes, you can, as long as you can get access to those funds in 24 hours. Yes, you can do that. Once you have to, it takes about 24 hours to get the funds. It's not an emergency fund. So yes, you can open a fund account and use that as emergency funds and put money in. Yes, that's fine. Yeah.
Thank you. For my second question, this is a little bit of a tangent. So I've been trying to wrap my head around inflation over the past 24 hours. I want to really know how inflation reduces our purchasing power or our wealth. So, initially the idea that I had in my head was if price is increasing by 16%, it means, if inflation is 16%, it means the rate at which price is increasing is 16%. And I was translating that to mean that I'm losing 16% per year. But now, what I discovered recently is that inflation is not actually saying price is increasing at 16%, but it is saying the rate at which price is increasing compared to the base year is 16%. So I want to know, with precision, how can I mathematically model it to see how much I'm losing in a year if my cash is sitting idle?
So the way you have to look at it is this, right? What is the opportunity cost to your idle cash? That's how you want to calculate it. If inflation goes up, the bank interest rate goes up. You see it? So inflation goes up by 10%, the returns your bank is paying you should also go up. So if you keep cash idle at home, what's the opportunity cost of that cash? Is that interest rate you would have gotten from the bank or from the bond? That's what you're losing, not the inflation rate per se, but the risk-free rate that you would have gotten if you simply took that money to the bank and invested it. Because inflation is not an investment. You can't put money in inflation. But if you put the money in a bank, you would have reduced the loss that the money would have faced with inflation. Remember, MPR, monetary policy rate, is the base rate in the economy. So if you have 100 naira in the bank last week, and the MPR before the meeting with CBN was about 27%, if it has come down to 26%, you would notice that the fixed deposit or whatever the bank might pay you might have come down. So what you want to ask yourself is to say, what am I going to lose if I don't invest? That's the loss to you, not like you said, the actual inflation rate. The inflation rate drives the MPR, and then that drives what the banks pay you. But the loss to you is going to be the opportunity cost of you not investing in a risk-free fixed deposit. That's how you want to calculate it. And that's going to be simple and methodological for you to calculate in any time. Yeah.
Thank you very much. But I don't think any bank is paying 26.5% on savings. So
yes, the MPR is when they borrow from the CBN, not when they pay. They're not going to pay 22%. But when they go to the central bank to borrow, that's what they pay, right? So if you go to borrow from them, they will charge you 22 plus. So what I'm saying, what you want to benchmark against is the risk-free rate in Nigeria, which is the federal government bond or the federal government savings instrument, not the bank, the risk-free rate. So you ask yourself, if the risk-free rate is 19%, which means if I take that money, from my pillow and I give it to the federal government, which is the safest investment in Nigeria, I will make 19% or 17%. That's what you are losing by keeping that money at home. That's your opportunity cost. That's what you say you have lost because you did not invest. Do you follow?
It followed, but I still have just one tiny scratch. Like what I'm trying to get at is that if I cannot tell with precision how much I will lose to inflation, how can I know that investing in government bonds is beating inflation?
That's what I'm saying. There is no investment called inflation. You can't go to the market and say, I want to invest in inflation.
Mr. Kalu, I'm saying, is the goal not to invest in an instrument that beats inflation?
No, the goal is to invest in an instrument that meets your objectives. So your objective might be to get income. If you're a retiree, you can't take risk. The way you beat inflation is to take risk. The volatility is what beats inflation. But if you are 65 years old and you are a retiree, you can't take risk. So you have to eat that inflation because you can't do anything about it, because you can't take your pension and buy crypto to beat inflation. So your question is, how can you determine with certainty what you are losing? I'm saying you can't invest in inflation. You have to look at the economy and say, what would I have gotten risk-free, not crypto, risk-free, had I invested? What's the guaranteed return I would have gotten? The guaranteed return you get in Nigeria today is whatever the federal government is paying you. That's the guaranteed return. That's what you benchmark with. So you then say, what is my guarantee? It is the federal government savings bonds or the federal government bonds or treasury bills. Choose whichever one you want to choose. That's what you are losing by not investing, because you can't invest in inflation. You only invest in a security like a bond, a fixed deposit, government security. You understand what I'm explaining? So you can't say, I want to go and buy inflation. You can only buy a bond. What bond? The risk-free bond in the economy is what you're going to benchmark to say what you would have lost had you not invested in the economy.
So, Mr. Kalu, at the end of a financial year, my financial year or a year, how can I tell? How will I know that I have beaten inflation with my investment?
You pick
with my return.
You pick the inflation rate, the real rate. You have to do a relative comparison. What are you investing in? Give me an investment. What are you investing in? Tell me.
Let's say stocks.
Okay.
My portfolio.
Okay, so what is this stock? The stock return? You have to use the all share index. The all share index, you compare it with inflation. That's what you do. You compare the all share index with the inflation rate. So inflation rate in Nigeria last year was what? 15. All share index was 50. So your stocks beat inflation. Same with bonds. What are bonds paying you from 15 to 20? What was inflation about 15? So you compare the yield that you make from the investment, your dividend yield, your stock yield, your real estate yield to the inflation rate. But I'm answering that there is no investment called inflation. You compare inflation with an investment that gives you a return, right? So if you take your portfolio, you say, I had a portfolio of stocks, bonds, you can do the average return, and then you compare the average return to the inflation rate in Nigeria as at December 31st, 2025. That's what you do. Make sense?
It does. But final question. I did not invest. I kept my money under my pillow.
Okay. So if you didn't invest, you're asking the same question. I'm not sure the answer you want to get.
Yeah.
If you didn't invest,
yes. Wait, let me just quickly land. I did not invest. I kept my money under my pillow. It's the end of the year. How will I know the percentage of that value of my money that I've lost to inflation?
Simple. You compare the opportunity cost that you would have gotten should you have invested in the risk-free investment in Nigeria. So let's say you kept ₦1 million at home. You did not invest it. You say, okay, if I had taken this 1 million and I had taken to the federal government, which is the safest investment in Nigeria, what would they have given me? They would have given you between 15% to 20%. So you lost 15 to 20% because you didn't invest it. That's the opportunity cost of not investing. You compare that with the inflation. You can't invest in inflation. You invest in an asset class. You compare the yield of that asset class to inflation. That's what I've answered you for the first time you asked.
Sorry, Kalu, if I can just chip in here, just to buttress some of your points and give some nuances as well. Also, like, let's think, the first rule of investment is capital preservation. Don't lose, right?
Yep.
And there's an account I follow that, like, just like Olumide Adesina, he always tweets, return of capital is better than return, or is more important than return on capital. Meaning, it's better you get your principal back with no interest than to lose some or all of your principal.
Correct.
Now, to beat inflation, like Mr. Kalu just said, you would have to take more risk. If you notice the word he's used, on the bonds he explained, before yields comes toward risk-free. Basic, as in finance 101, or business 101, higher risk, higher reward, meaning vice versa, lower risk, lower reward. So if you are buying a bond issued in a government corridor, you're buying the safest asset in that economy, and so you would not necessarily get the level of returns that you might need to beat inflation. You could still beat inflation, but it all depends on a number of variables. How to compare? Obviously, Mr. Kalu has already explained them how to compare. What?
Excuse me. Sorry. I'm trying to really get this comparison. Mr. Kalu, please. I'm sorry if I'm making you repeat yourself. Yeah. I'm just saying, in the event where the return on government issued treasuries and bonds is lower than inflation, how can I tell that this particular channel is not beating inflation?
But I'm not sure the question you're asking. If the return is lower, then it's not beating inflation. So what are you asking really?
What I'm asking is, if I don't know how much inflation will take from the value of my money, I
think I understand what your question. You are asking. So look, don't be academic with this, right? So if I want to be academic, you can say you take inflation rate, then you take away the returns you make from, say, shares. That's simple. You are asking that you didn't invest the money. So because you didn't invest the money, how do you know what your money at home has lost from inflation? So you are being linear. You are looking at the money at home and you are comparing it to inflation rate. And I'm saying the way you know is that you have to assume that money you have at home was invested. You have to assume you invested that money. You can't compare money at home with inflation. It doesn't work that way. You have to take that money and say, okay, let's assume I invested this money. Invested it where? You have to use the risk-free, which is the lowest return you would have got in the economy. Risk-free means lowest return. It should mean, I mean. So that means if you look at the whole of Nigeria, the lowest return you're going to get is your risk-free return. What is the risk-free? What the federal government is paying you, not state, not local, federal government. Why federal government? Because they can print money and pay you back. So you say, I assume I took this 1 million naira and I took it to the federal government of Nigeria. What would they pay me? they will pay you maybe a federal government savings bond return, which is, like I said, from 17% to about 19%. That's what you would have gained. So your return is 17%, right? What is inflation? 15%. So you lost 17% because you didn't invest it. So you're not going to say it's academic to say I have 1 million, inflation is 20%, so I take 20% of my 1 million. That's academic. Reality is that that money you have in your house, if you had invested it, the yield would have been 17%, but the inflation number is would have been 15%. So your real return is 2. 17 minus 15. Do you follow what I'm saying, sir?
I do. It's just that I think I'm a victim of the rhetoric. You know, what you hear is that Nigerians have been plunged into poverty by inflation. Our wealth is eroding every day because of inflation.
That is
so
correct.
If they cannot
that is correct.
They cannot precisely tell how much we are losing.
But it's because you are talking about
how come that rhetoric is correct?
Because if you go to buy rice, because you are looking at it naira at home. If you take that 1 million, you want to buy rice January, you'd have bought a bag of rice, just example, for 45,000 naira. If you go to buy a bag of rice in December, you buy the same bag of rice, example again, for 60,000 naira. So you need nearly 20,000 to buy the same asset, but your income has not increased. So your salary has gone down, even though your employer has even increased your salary. Hence, your purchasing power has gone down. That's why people say high inflation causes you to get poorer, because your employer might increase your salary by 5%, but cost of goods have gone up by 15%, which means you have lost 10% of your income. That's why they say that. You are asking a different question altogether. You are asking, how can I compare cash I have at home to inflation? That's how you compare it. You compare the yield to the inflation return, the CPI. But if you're asking if inflation destroys net worth, of course it does. The reason why central banks were even created in the first place was to fight inflation, because it destroys economies. It led to the Second World War. Look at what happened in Germany. That's why they said, okay, we have to have a mechanism where we cannot allow currencies to inflate so much that economies are destroyed and people then go to war. From the First World War to the Second World War, you had a hyperinflation in Germany. So the worst thing you can have in any economy, my brother, is inflation. Worst.
Yes, I understood. But what I'm trying to, okay, let me not ask again, because I've asked enough. But I'm just saying, I wish there was a way you can model the potential loss you will make on your cash if not invested.
I have told you the way. I think you just don't like the answer. I've told you the way to do it. I'll say it again.
The answer you gave me, the example you use is an example.
It's not an example. I am telling you, it doesn't matter whether it's higher or lower.
What if lower than inflation?
If it's lower, then you made money. Listen.
Then I lost now because inflation is higher.
Ohaifu, you are Ohaifu, as long as you did not invest the money, you have opportunity cost, not inflation. You are jumping.
I'm supposed to be comparing my money to inflation.
Ohaifa,
the killer of wealth?
No. Your money was not invested. So your first issue is that you have lost money because you did not invest it, first of all. That's why I said
inflation, right?
Not inflation, opportunity cost. What is opportunity cost? You had money in your pillow. You didn't invest it. You've lost money.
Mr. Kalu, okay, let me suppose a scenario.
Let him understand. Zero. Let him understand. I think let him understand. I want him to understand the point I'm making. Haifo, you can ask as many questions as you want. The point I'm making to you is this.
What I'm saying is in the event, let's say treasury bills, government issued bonds is going at 2%. That's the risk-free, safest 2%. And inflation is 13%. Should I be comparing how much I'm losing in a year to that 2% as opportunity cost, or to the prevailing inflation rates?
Did you buy treasury bill or the money at home?
I did not buy treasury bills. So
okay,
you
so
said I should compare the opportunity cost to treasury bills, which is I would have made 2%.
I didn't say that. Calm down, slow down. You are going too fast. You are arguing. You're trying to argue your way out of this. Listen to what I'm telling you. If you invest, you compare the yield to inflation. If you don't invest, you have already lost the opportunity cost. You are jumping from cash to inflation. No. First of all, you did not invest. So you've lost the 2% already. You've already lost that 2%. Agreed?
Agreed.
Good. When you've lost that 2%, the cash you have in your hand, when you go to the market, are the goods going to be cheaper or more expensive?
They are going to be more expensive. But the crux of my question is, how much more expensive? How will I know?
You only know. For last time I'm going to explain this. You are asking two questions. There's a consumer price index, which is you are comparing a bag of rice today and a bag of rice in a year's time. That's consumer price index.
Is that not inflation?
Hold up. That's consumer price inflation. There's another return, talking about the return on the yield. I've given you two answers. I've told you, if you invest, you compare your yield. If you have a house in Ikeja and that house pays you $1 million, right? And you bought that house with 100 million, your return is 1%. You compare the rental yield to inflation because you have a house, you invested in that house. If you don't invest in a house and you have 100 million in your pocket as a check, someone gave you a check, you didn't cash it. The first thing you have to understand is that because you haven't invested it, there's no yield. There is no yield. So what are you comparing? You can't compare no yield to yield. So you compare that you have lost the opportunity. Okay, let's move on. We have to move on. Zero, go ahead.
Kalu, please.
Zero, I'm not hearing you. I can't hear you. Let me just go a few messages here. Okay, just to be clear, let me see this one. Hey guys, Zero, go ahead. But I can't hear you. If you're speaking, I can't hear you. So this is a good question. Let me just look. Yeah, just want to understand. Can you? Let me see this. I think I'm learning, but the naira volatility and inflation make USD and Euro bonds feel safer. Main Nigerians now prioritize currency stability over local. Yeah, that is true. That's true. So clearly, you can see that the dollar bonds are actually very, very good because they pay you a return. The money in DOM account, I don't think it pays you a return or Olajide. So you are totally correct because Nigerians can invest in dollar and get a dollar return. They love the dollar rate. So that's why they are throwing a lot of money in there. Like 1.9 trillion is put in there because they can get a return back. And because the Naira, the returns on the property, equities, bonds are all in Naira, which are subject to Naira inflation, then they don't really feel that confident that they are buying bonds. I say the funny thing, most of the guys that are buying these dollar funds are not even Nigerians in Nigeria. The bulk of them are Nigerians, specifically in the UK. I think I read a report about 30% of the FPI, the foreign portfolio investment in Nigeria, is coming from the UK especially. So the UK guys are taking the dollars from their bank accounts, even if it's pounds. They are taking out forex from their bank account because they're getting very, very low rates and bringing to Nigeria to buy the same currency in Nigeria, but they're getting a dollar return for their dollar in Nigeria. And then they're taking that money, either take it back to the UK or they're just leaving it here to make money. So it's a win-win for them. If you have dollars and you live in America, live in the UK, Dubai, Canada, Nigeria is giving you an easy way to make money. I couldn't hear Zero. Stateless, what's up? Stateless, go ahead.
Yeah, good evening. Thanks for the information you've been sharing so far.
Thank you so much. Yeah.
I joined a bit late, so I just wanted to know what exactly, as a Nigerian, what exactly should we invest in? Should we jump into Rise Vest? I've been scared of investing in Naira investments. So I have a little thing going on Bamboo.
Yeah.
But I've not gone far or so deep into it.
Yeah.
I just put 2 million Naira in it, and I'm just okay because it's in dollars, right?
Correct.
But everything Naira has always not been making sense to me, whether the NGX or the profit they're making. I feel Naira can decide to drop to us 118 tomorrow, and all the gains you made on the NGX over the course of last few months, or all the trends that came with, everything can get easily wiped off just by that drop. So I don't really look into Naira investment. So which of the dollar ones do you suggest, or would you advise we go into? Is it Rise Vest? Should we rise to continue with Bamboo, or are there other opportunities?
I think if you want the actual companies that do dollar investments, I can share them. I can share them right now for you. But like I always say, you want to ask yourself, why are you investing? So in this case, I assume you want to invest in the dollar. You're interested in the dollar. Is that it? You are interested in the dollar. Yeah?
Exactly. Yeah.
Okay, so I'll just share with you. These are all the SEC registered dollar funds, right? So I'll share it with you on Twitter. I think anyone there should be fine because they are all SEC registered. Then you can go again. Remember, these are just the funds. These are the funds, right? These are not I don't think RiseVest has a fund. This is like Afri Invest Dollar Fund, ICO Eurobond Fund. So let me just share it for you on Twitter. Then you can just you can basically, anyone you like here, contact them. I mean, if you ask me to recommend one for you, a long time ago, we had the guys here from FCMB. They have the Legacy USD Bond Fund. They were here with us a long time ago. They were here, and we had we spoke with them. So they're not bad. I mean, but there are other folks that are here as well. So I'm going to share all of them so that there's no favoritism. And I think you should just call them. What I'm sharing now is the Eurobond. Let me just copy that. So just go to Twitter. Are you following that trend on the space? This trend on the space. Are you on that one?
Yeah, I'm there. I can see the.
Okay, so I'm just going to share this now at the very, very on the screen. So you're going to see all the Eurobond, the companies that basically do offer. This is Eurobond I'm sharing. I'm going to highlight right it again. So just say Eurobond. Then I'm going to share the fund. So this is Eurobonds. Eurobond vendors, or should we say, vendors a good name? Okay, I've shared Eurobond vendors. And so anyone there I think is fantastic. Let me share the fixed income folks. These are going to be the ones that do fixed income for you. So like I said, go online, get their phone number, call them, say you got their number from Kalu or whatever, and that you're interested in investing. What are their rates? I think they're going to offer you. Look for the one that has the cheapest. I would advise you look for the one that has the cheapest rate, i.e. cost to invest, because it's the same dollar you're buying. So why pay more to buy the same asset? You understand? Still there? I think it's dropped off. Yeah. So I've just shared that with you both. So you just go ahead and get them. This is a fixed income. Zero, let me add you real quick. Or before Zero comes in, Paul, how you doing? Paul and Nature, what's happening, man? Paul? I got stateless. So stateless, other stateless.
Hello, Kalu. Can you hear me? Good evening.
Now I can hear you, Paul. What's happening?
Yeah, I'm actually watching, following on YouTube. I just switched here. I just to get clarity to your last point. Are you saying it's you're advisable to invest in dollar more in Nigeria than to invest outside of Nigeria? To your last point about people from outside.
No, what I'm telling you what's happening. I'm not giving you advice. I'm telling you what is happening. I'm saying that what is going on in Nigeria is that you have many Nigerians that, because in the West fixed income rates are very, very low, right? If you're in the US today and you try to invest in a certificate of deposit, you're going to get anywhere from 2 to 3%. So what Nigerians are doing, Nigerians are essentially taking the same dollar, coming to Nigeria to get higher dollar returns on fixed income and Eurobond funds. That's what Nigerians are doing.
Kalu, can you hear me, please?
Yes, I can, Paul. I'm not sure if you heard me. I was explaining to you.
Hello?
Paul, I can hear you, yeah. Paul, I can hear you. Yeah. So, Paul, yeah, I can hear you. I just replied to you what I think Nigerians were doing, and that's basically what, like I said, I read a report that 30% of the FPI was coming from the UK, and those are usually maybe Nigerians that are coming back to the UK to invest in Nigerian fixed income. That's basically what I heard, and that's what I've shared, Paul. So, if you go to the YouTube link, I've shared it there. Fixed income dollar vendors. Yeah. So Paul, I've shared it on the space, or you can reply on the YouTube and I'll read your reply. That's basically what we're talking about here. Let me go back to YouTube. I think you should be there. Yeah. Yeah. Oh, let me go there. Yeah. I can also do it on a space on a chat here. Yeah. So if you go back, Paul, that's essentially what we're talking about. That Nigerians are investing a lot in fixed income dollars in Nigeria because of the higher rates. Really disappointing that Nigerians are not investing in equities or even infrastructure funds. That's how we grow the economy. So the PFAs there should be a way to make the PFAs invest in infrastructure funds. We can't grow the economy if we only have about 146 billion in infrastructure funds and about 5 trillion in money market funds. That's short term. It doesn't do that much. We'll have to move that up. Guys, believe it or not, to be here for close to 2 hours. Yeah. So I think we should start to wind it down. So yeah, close to about 2 hours and about 30 minutes. So if we don't have a lot of questions on the space, we'll start to wind it down. I'm just going to do a quick glance over on Twitter, see if I can read one or two questions there. Yeah. Yeah, so on the discussion on inflation, you are saying I should compare inflation. Yes. So what you want to do, again, just to clarify what I was trying to make you can only compare yield if you are invested. If you are not invested, you can't be talking about yield, right? It's like saying you have a piece of land in your village. Then somebody says, I have a farm in my village and my farm is yielding me 20 yams every year or whatever. And then you are saying, oh, I want to compare my yield with your yield. You really can't compare both yields because you're not planting yam. You have to first of all plant yam on your own farm before you can compare the yield on your farm to the yield on another farm. You see the point about yield. Yield is how you compare. When you want to compare bonds with equities, or you want to compare bonds with real estate, you look at the yield. You say, what is the dividend yield? What is the yield to maturity? What is the real estate yield? When you compare that, that's what you compare. The yield, not the return, not the coupon, not dividend, but the dividend yield. So if you have cash, you can't compare cash to, say, inflation or to, say, bond yield because you haven't invested that cash. That's the point I'm making. When you invest the cash has a yield. That's what you compare to inflation. If you want to compare that cash, you then look at the consumer price index, where you say, okay, I want to go and buy tomato. And to have cost me $1 million to buy tomato this year, but it cost me $2 million. I compare the CPI, the consumer price index, the rate of change of prices in the basket in the economy, not yield. The CPI is not looking at yield, it's looking more at the rate of increase or fall in prices. Oxley, how are you doing today? Oxley, talk to me.
Yes, I'm doing okay, Carlo.
Fantastic.
Yes, so talking about the fixed income, right?
Yeah.
There's a hypothesis that I have, and I can be corrected if I'm wrong, which is the CBN has consistently Okay, so the inflation has consistently trended downwards in the past. If I'm very correct, in the past, it's almost getting to 1 year. Inflation, in fact, currently, I think the CPI is below 15%. And we know where we came from after the rebasing, right? Now, I am thinking that the fixed income yield is rigged. I'm thinking that it's rigged because the CBN has kept rates the way it is on purpose because they don't want to upset the portfolio investors. They still want the portfolio investors to keep their money within the system. And for how long are we going to continue to please portfolio investors? You need them, I understand. You need them. But I'm thinking that this rate is rigged. The fixed income yield, talking of bonds, talking of treasury bills, governments, and the other funds, private companies and banks and other companies issue their dollar fund, their euro fund, and all of that. I'm thinking that it's rigged. You can disagree with me, but I mean, why would the CBN not bring down rates?
I want to use the word rigged. What is their objective? If my objective is to attract foreign portfolio investment, it's perfectly legal to keep the rates high. It's not rigged. It just means my objective is to bring in FPI to Nigeria. You won't call that rigged.
At the expense of what? That's
at a higher the servicing cost for forex debt, which is you are correct. But it's not a rigged, right? It's just to say that they are paying too much to attract capital into Nigeria. That is fine. We can make that argument and say the CBN's policy is to attract capital to Nigeria. That's fine. Doesn't mean it's rigged per se, right?
Maybe I'm using Donald Trump's basis when he has pressured the Federal Reserve to bring down rates because the Federal Reserve Bank is not managing the rate in line with inflation. So I'm thinking that because the cost that CBN is putting on the system is the real economy is suffering. Rates need to come down. There are a lot of benefits.
So you're saying
bigger benefits.
You're saying
keeping
two things
down.
Yeah. So you're saying Okay, let's go back to your point. So you see, when the Central Bank of Nigeria wants to fight inflation, it will raise rates, right? So I agree with you that, to me, this is my personal opinion, you can't fight inflation in Nigeria with just raising and lowering interest rates, because what is causing the inflation in Nigeria is not the monetary pressure alone, it's the high cost of food. And the high cost of food is coming from the insecurity in the food-growing areas in Nigeria. So even if Central Bank of Nigeria takes monetary policy rate to zero, there will still be inflation because there's no rice, there's no tomato, there's no yam in the markets in Nigeria.
But at least let them reflect the rate, the inflation that has trended downwards over a significant period of time. It has trended downwards.
No, but if they do that, right,
at least
I think, look at what I think, right? I think that the food inflation in Nigeria has gone down because food has gone down. But food prices have gone down because the food is imported. Food imports have gone up. So I think there's a thinking that, listen, inflation is only down because we're importing food. If you reduce rates and we stop imports, it's going to go right back up again. The only way
you can't have the argument both ways. Yes, if you are importing food, it's okay. Let the rate come down so that the manufacturing sector, the business sector can benefit from low interest rates in terms of borrowing from banks. The CBN is trying to eat their cake and still want to have it.
No, I agree with you. The point I'm making is that I understand what they are doing. I don't agree with it. I'm with you. I don't agree with it. I think we have to also focus on growth and say, if we can bring rates down, SMEs can get loans at a cheaper rate to
people
invest.
Are borrowing from banks. There is a benefit to the real sector if the rate comes down. The CBN is only trying to compensate one segment of the market, which is portfolio investors. For how long? They have to make a call at some point that, hey, let's make this decision. That's my view, though.
Understood. You have a view there that is shared by many. Like, I also want the rates to come down. Without rates coming down, we really can have SMEs growing. So completely agree with you. Yeah. Completely. All right, fantastic.
All right, thanks.
Yeah,
Thanks, Kalu.
fantastic. So I think I've addressed what I wanted to address was to share bonds. Let me just summarize as we close down, right? So I wanted to share that bonds should be a part of your portfolio, right? For any of you, even though you're a young person, like I've said, if you're younger, you want to do more of fixed income in sort of equity investment because you are younger. I still think you should have this insurance and also understand how bonds work, which is what we've done today. So I hope that you can go back and play this and use this as a stepping stone. Try to Google most of the stuff I've said and try to learn also on your own. If you go on Google and you plug this in, there are a lot of free resources on YouTube that you can learn more about bonds, how to invest. Are you interested in Nigerian bonds? You have to speak to a SEC-approved bank or SEC-approved issuing house. Most of your stockbroking firms can buy you a bond. Most of the banks that have investment arms can buy you a bond. Try to do a portfolio. So you have your equities, your bonds, your portfolio in a portfolio that can rise and fall and is hedged against fall and rises in the market as well. Don't just go into one alone. Try to learn before you buy. And I think we've given you an introduction or a stepping stone. Most of the stuff I've used here, guys, are from my book. Most of the visuals you are seeing here are from my book. So you can imagine what you get if you do get the book. You're going to find most of these visuals in that book, and it can help you to read and understand. It's written really for Nigerian market, but it's still international themes. And we have about 3 or 4 chapters on bonds and fixed income in that book, where we mention the funds that you can buy for specific objectives that you can use to achieve that financial objectives. Ola, real quick, well, winding down, do you have a question, Ola?
Okay, yeah, Oga Kalu, how are we doing, sir?
I'm doing very well.
Do you want to share those links for those learning about those fixed income and other securities? That would be great. Thank you.
Links. I will just go to YouTube and just put fixed income. You just put free resources fixed income on YouTube. You get tons of stuff there. Yeah.
All right, that's fine.
That's the best way I think you can actually pick up on all this stuff, right? All right, fantastic.
All right, thank you, Oga Kalu.
You're welcome, man. I appreciate you, sir. All right, guys. So thanks so much for hanging on me on a Sunday. Let's hope for the week. It's a trying time. I will say there are lots of opportunities in the market right now. You can see everywhere is red. If I pull up the US markets futures, let me just take a quick peek and see how it's looking. Yep, it's all red. Everything is all red. Crude oil seems to have recovered to about 99, but everything is red. When you see red, to me, it means a discount, because what's happening is that these companies haven't changed. Amazon, Apple, Exxon, Walmart, those companies haven't really changed, but there's an external issue occurring with them that is pushing their future earnings or the projected future earnings down. So the market says. So the market is pricing them downwards. To me, it's a buying opportunity, because the market will always go up and down, but the market is falling by 1%, nearly 2% over a war that we all know, no matter what happens, this war cannot continue for a quarter. There's no way they're fighting this war 3 months from today. So if this war is going to end in 3 months from today, all that we're going to worry about is that, okay, I don't think there's any worry that oil will not pass through the Strait of Hormuz in 3 months. I don't think oil is going to affect the U.S. market. U.S. doesn't really import crude oil. California does, but the U.S. really doesn't. They have a lot of their oil. So I will look at that as an opportunity to buy these stocks on a discount. If you buy them today, the market reprices their future earnings. You've gotten in at a discount, especially if you are buying funds. This is my personal view, that it's a discount because the markets are, I think, overpricing the negative news. It's a war, yes, but I don't think it's really this bad. If there was no oil issue here, would the markets have gone down by 2%? And if we're here, the Iranians are seeing that every ship can pass, apart from the Americans and the Israelis, it almost looks like it's over, because if China and India get their oil through there, then who else are you blockading? The US doesn't go to do Strait of Hormuz. Israel doesn't do Strait of Hormuz. So I think it's a buying opportunity for those that are long term. This is the time for you to buy this good ETFs that track the entire US market at a price now that is good. Because unless you say that the market is going to be at this price in the next 12 months, if that's your your prognosis, then don't buy. But if you think that the market is going to reprice itself once the war is over, then what are you waiting for, right? If it's a long-term play, go ahead and take advantage of the discount in the market right now. That's how I will put it. All right, folks, I'll see you guys here again next week when we do talk again about money, the economy, and of course, finance as usual. My name is Kalu. I just want to thank you guys for hanging out with us for nearly 2 hours to talk around bonds. We're always here every Sunday, 7 p.m. West African time. And I hope I'll see you guys again next week. Do take care of yourselves. Bye. And I love you all. Take care.